So we appreciate everybody taking the time to join us this morning to talk about a few new and upcoming topics that are going on in the nonprofit world. So my name is Ken Youngstead. I'm a partner with Craft CPAs in our nonprofit practice. Actually joined Craft in 2006. I've been here about 15 years. We have with us today Fran Leahy and Sean Owens as well, and I'll let them give a brief introduction. So Fran.
You're
And
muted,
Fran
still, Fran. You're muted.
There we go. Now I'm unmuted. My name is Fran Leahy, and I have been with Craft for 12 years. I'm a senior manager over tax services in the nonprofit team, and nonprofit's all I do. So no other tax services. I've been here 12 years. Sean?
Okay. All right. My name is Sean Owens. I'm with Craft CPAs. I've been with Craft CPAs since 2003, so 18 years, and I'm a partner in our audit insurance services division.
Great, thanks. And as we get started, just as a reminder of what Debbie had shared with us, if you'd like to have CPE for today's session, we'll have 2 hours of CPE available should you need that. There's an evaluation form, and we will go through the presentation. There'll be 3 different keywords that we'll mention throughout the presentation. And if you'll just jot down those keywords, that'll be what you'll need to put on the evaluation form, and you'll send it back to us. I think there should be an email on that form. Of course, if you have any questions, feel free to reach out to us. I think we'll have a few days before we need to collect those forms, so you have a little bit of time after the seminar today. But just be sure to jot down those keywords should you need CPE, and we will go ahead and get started. So Fran, I'll turn it over to you to get us rolling.
Okay, thank you, Ken. And I think we're all operational now. I've already gone through the first, oops, you're on mute. So today we are going to go over a few things with the stimulus package, just some overview of PPP, ERC, and SBOG. And if you don't know what those mean, you'll get an idea in just a little bit, but you've probably heard them many times. Then we're going to talk a little bit about the watchdogs, and we'll have a spotlight on one watchdog and how it would affect your organization and what you can do to change your score on that watchdog, on their rating system. Then a little bit about UBI and NOL, some other tax issues. Then we're going to hit leases on the financial side and in-kind contributions also with the financial side. So we're going to start off with a little bit of tax and stimulus if you've not had enough of it over the last year and a half. So PPP, obviously it has stopped for actually getting the PPP first and second draws. And so now we're just working on forgiveness. So for the 2020 loans, 84 applications have been submitted, representing 88% of the PPP loan dollars. Now, these are facts from August 15th, so they probably have changed just a little bit. There is still remaining 804,000 loans totaling $65 billion. And loan forgiveness rate is about 99%. So that's really good so far. I don't know if the ones that are going to have to pay back the funds are waiting until the last day or what, but 99% is pretty good. If you have a forgiveness of 150,000 or less, then you can talk to your loan provider about going into the direct forgiveness portal, and that would help a little bit. They keep on tweaking that a little bit each time. It used to be a simple form that was not so simple, and then it got more simplified as we went along. So it is getting more simplified. The next thing is the employee retention credit. This is a credit that's claimed on 941, which is your payroll tax submission, quarterly payroll tax submission. And it is for eligible employers. And we'll talk a little bit about what eligible employers is in the next slide. But for eligible employers, the 2020 credit, which you would need to go back and amend your last year's 941s, but the credit is 50% of $10,000 of wages per employee in the year. And then for 2021, the credit is 70% of $10,000 of wages per employee in the quarter. So obviously 2021 is bigger dollars. It's very complex. It's not just this one slide. And if you've got any questions, please come back and shoot them to us on this. But the wages depend which employees are eligible for this. Employees depend on the size of the organization. So if you have 100 or less employees, then all of your employees can be counted towards this credit. If you have, and that's in 2020. In 2021, if you have 500 or less, then all of your employees can be counted. Now, what if you're over those thresholds? Then it's just the employees that worked, that didn't work, but got paid. So they got paid, but they were at home. You were just paying them out of the goodness of your heart. Those are the ones that are eligible. Now, are you confused enough? We'll talk a little bit about the eligible employers. So in 2020, the eligible employers are those that had quarter per quarter, 2020 over 2019, gross revenues decreased by 50% or more, or they had a partial or full shutdown by government mandate of the operations. And you can't say, well, we just couldn't go in. That's not, there's specific examples. If all of your people, for example, went home and they worked, maybe they weren't as efficient, but they still worked, then that doesn't count as a shutdown or partial or full. So you really have to look at the examples. The IRS has a lot of FAQs on their website with specific examples on that. Now for 2021, an eligible employer is those that had quarter per quarter comparison of gross revenues decreased by 20% or more from 2021, looking all the way back to 2019 as your base year. So they just took out 2020 as a comparison in there because they knew that would not work. So there is, and that's a decrease of 20% or more. There is an alternate methodology for that for 2021 only. You can look at the previous quarter to see if you can meet that. And if you meet it in the previous quarter, then that 20% or more reduction, then you're good for that quarter. So say, for example, quarter two, you're looking at 2021 quarter two, you can either look at quarter two 2021 over 2019, or you can look at quarter one 2021 over quarter one 2019. And if you had a decrease of 20% or more, then you are eligible for either quarter one and quarter two. Okay, so and obviously for the first quarter of 2021, you would go back to the last quarter of 2020, compare it to 2019. Whew, a lot of numbers. Let me know if you have any questions as you go along. I've talked to a lot of our clients on this. It is so confusing, and a lot of people have payroll providers. Some payroll providers understand this fully, some don't. So just make sure you understand this. One last thing that makes you want to understand this is just today, when I opened up my email, there was an IRS had issued today a temporary proposed regs that basically state that any employee tax credit that is not allowed. So say, for example, you actually file it for the second quarter of 2021, and you file it and you get a refund, and it was calculated wrong. Maybe you used the wrong numbers or something like that. It is going to be treated, that underpayment of payroll taxes is going to be treated as an underpayment of payroll taxes. The IRS is really strict on that. And so there will be penalties associated with that. So make sure you understand what you're filing. You are filing a tax return with the 941, and it is, the IRS considers that very serious. So make sure you understand the whole calculation. Okay. Now, we've talked about the ERC and the PPP. We're going to talk about the SVOG in a minute. That's Shuttered Venue Operators Grant. And Ken's going to talk about that in a minute. But just sort of keep this little caveat. You cannot use the same wages for PPP forgiveness and the ERC and the SVOG. They have to be completely separate wages. So if you used all of your wages in PPP, then obviously you can't do ERC or SVOG for wages, okay? So be very careful, make sure you have this documented really well. Also, you cannot use the same wages that you received credits for paid sick and family leave that was related to COVID-19. So you had employees that maybe had to take care of someone or could not come in because to work because of family leave issues. They didn't have daycare providers, etc. And those were paid and your wages were reimbursed through that credit that you received. You cannot use those same wages for ERC, PPP, SVOG. Okay. PPP and ERC. So most of you have had all of that. You're sort of understanding it. You understand PPP, you're waiting on your forgiveness, or you've already gotten your forgiveness. And now you're looking at your ERC, maybe you've already done it. How do you record them? For tax purposes, the PPP is recorded as a loan on the Form 990 until the time it's forgiven. Once it's forgiven, then you record the amount as a government grant on the Form 990. Now, this could differ from GAAP treatment. So on the financial statements, you do have the option of either recording it as a loan or as income. And so you may have recorded it as income in 1 year, but on the 990, you have to record it as a loan because it's not truly forgiven. You cannot record it as income until it's truly forgiven. The ERC.
Yeah, let me chime in here
Yes.
for just a second, Fran, and say that we, I know that some of you may have used that gap treatment as a conditional contribution where you've met the conditions to record it as income on your financial statement before the forgiveness time. The AICPA actually spoke directly to that point, and so that is an allowed treatment. And clarification along the way in that for the 990, it should be treated as it's as income once it's forgiven, as Fran mentioned. So,
right, we need that actual document from the SBA saying you're forgiven, and then it's income on the 990. So you may have a timing difference on your 990 depending upon how you've treated it on your financial statements. Thanks, Ken. Okay, the ERC. So you record the ERC, the Employee Retention Tax Credit, as a receivable to the extent that the recovery of the amounts are previously paid in 2020 and 2021 are probable. So say you've already submitted your 941X, you expect to receive it back. It's probable, that's when you would record it as a receivable. You don't have to go back and restate the 2020, even though it applies to 2020, you are putting it in 2021 in the current time that you file the 941. And then when you've actually received the funds, which I have heard that it is a little bit of a time if you're amending prior year returns, it does take a little bit, but the IRS is starting to catch up. You would record the credit as a government grant when received, and you would reduce the receivable at that time. Okay. I think the next thing we're going to talk about is the Shuttered Venue Operators Grant, and Ken is going to discuss that a little bit.
all right, thank you, Fran. And so just a few items and we're really just scratching the surface on a few things that have kind of come out on the Shuttered Venues and Operators Grant. As a reminder, some of the eligible entities were live performing arts organizations, museum operators, talent representatives, different groups that were eligible, both for-profits and nonprofits alike on that front. And I thought this chart was interesting. This is something the SBA actually issued just a couple of days ago. They've been updating this chart over the course of the, the open period. But applications for the SVOG closed on August 20th. So they're not actually accepting any new applications. So this really is the population of the initial SVOG operator grants that they're looking at. And I think the things to note here is there was $16 billion worth of funding that was available through this program. And if you're looking here, the requested funding that was submitted is $13.3 billion. That's less than 16. So we'll talk about that a little bit. They've awarded $9.5 billion of grants that you'll see in that fifth column over on the top chart here. The thing that I also found that was really interesting about this is if you look at the awarded, grants and the declined grants, we're talking a little over 25% of grants have been declined. And so, to be honest with you, I'm not sure exactly what the dynamic is around the declined grants, but nonetheless, so they're looking at this pretty closely, I think, is a message. I think looking at the chart before this one, they had reviewed 98% of applications by early August. Now it's at 93. So there was a little surge there at the end of people applying right, near the deadline for these grants. With funding left available, there's a supplemental grant program that just want to make sure that you're aware of. So if you want to go ahead to the next slide, Fran. Let's talk about revenue recognition from the shuttered venue grants. From a revenue recognition standpoint, basically you would treat this as a conditional contribution. That's very similar to what we were talking about with the PPP treatment, where you had, the ability to go ahead and recognize the income once you've met all of the eligibility requirements and you've had the appropriate expenditures. So this shuttered venues operators grant is the same way. You treat it as a conditional contribution. But here's a catch. Many of the organizations on here or the nonprofit community in general, a lot of year ends that are not necessarily December 31st. So a lot of June 30 year ends, you could have others. So to receive a contribution, you have to actually be notified of a contribution, right? So that's the reason for this question. So you might have met the condition for your eligible expenditures, but if at your fiscal year end date, you haven't yet been awarded a grant, I'm not sure how you actually have a contribution before that date. And so, the clarification is that, let's say you're a June year-end nonprofit organization and you received your award letter in June. You've been notified of the award, you've incurred some eligible expenditures, you have revenue. These government grants, you would recognize revenue as you actually incurred those eligible expenditures for reimbursement. So again, your notification period in June for your June year end, you have some revenue. But let's say you received your notification in July, late July, that you've been awarded the grant. You really don't have a contribution until after your fiscal year end. And so there's a lot of ramifications on this with, in terms of audit requirements. We'll talk here in a few minutes about the uniform guidance audit requirement that you have with the shuttered venues grant. So again, I think the timing of your award and the timing of when you incur eligible expenditures, those are the key issues in determining when you're going to recognize revenue for this grant. Let's see, the grant period, I'll briefly mention that as well. The grant period for eligible expenditures is from that March 2020 time period when the pandemic began, and it runs through December 31st, 2021. So that is your covered period. So you might have a grant award, say for $7 million. You might have incurred $5.5 million of expenses by the end of your fiscal year. It is key to make sure you're just recognizing the extent you've had eligible expenditures for reimbursement at the end of your period. So there's some calculation you need to do to make sure that you've recognized the appropriate amount of revenue in the period. So this is a little tricky, to be honest. So, all right, Fran, if you want to move forward. So let's talk about single audit considerations. The SVOG awards are subject to uniform guidance audits. So this might be a new dynamic for some of your organizations, and I think it's really important. Uniform guidance audits are where you're basically looking not only at your financial statements as a whole, but you'll dig down a little deeper and have basically a program level audit performed as well, and reporting on that program, with uniform guidance requirements. So in many cases, well, just to talk about what qualifies or when you actually need to have the uniform guidance audit, if you have more than $750,000 of expenditures during a particular fiscal year or program period, then you're subject to the uniform guidance requirement. I would also say that some of your organizations, if you received an SVOG grant, and some of the amounts are pretty notable, or they could be notable, you might have other federal awards that you receive where you've never really had to consider uniform guidance audits, before. And so you will need to put together and document all of your federal awards in a schedule of expenditures of federal awards. And from that, we'd actually make a major program determination and selection, using all of your grants. So the $750,000 isn't just SVOG, that's all federal dollars that you'd be receiving. So another key is if you are subject to this uniform guidance audit, or even if you're not, just a word of caution that we've heard a bit here and there is that this might not be the only time, the audit process may not be the only time you actually have this documentation looked at. The federal agency, I think, has plans to look at more, some of these awards and making sure that you have those eligible expenditures. And so the key message here is to document your eligible expenditures well. Your payroll, your other theater costs, costuming, whatever it is that you have that comprise your eligible expenses. Make sure you hang on to that documentation, have it well organized. Your audit firm may look at it, and the federal agency may come in a year or two later even to look at it. So just make sure you keep that, under, good documentation there. And another thing is they've really kind of emphasized that the use of estimates are really not acceptable. You need to document your methodology of what expenditures are eligible. And to the extent you've got estimates of different things, you need to, they've really said you need to, try to cut out some of these estimates on the cost and have direct costs that you're, including as eligible. So documentation is key once again. Okay. Expense considerations on the next slide. So Fran mentioned this earlier, and I'll just reemphasize the point. We don't need to go deep in on it, but you do have to coordinate and not double dip with other federal programs for this $100,000 per employee threshold. So we're talking about the Paycheck Protection Program, Employee Retention Credit, and SVOG. To the extent you've got a payroll over $100,000 per employee, or it could be contractors as well. And the contractors are per contractor. That you have to coordinate those expenses. I think one change or one clarification that came out in a July 22nd frequently asked question, document that the SBA put out. They have lightened the burden on any moving around of expenses that you have between your budget categories, and so I think that's a little bit of good news. If you do have expenses from your initial budget, and once you put together, you will have to submit a final budget to the SBA, but you do have some flexibility to move your categories around a little bit, on that. And so that was clarified in that July 22nd frequently asked questions. If you have that scenario, you may want to take a look at that. Okay, now briefly on the supplemental grants on the next slide. So supplemental grants, as we mentioned on that first slide, all the money was not initially fully allocated on the program. And so those applications closed August 20th. You can no longer apply for an SVOG grant. They are opening up a supplemental grant period, and there's going to be more information or invitations sent out about this soon. It is my understanding from reading the SBA website that that they are going to be reaching out to applicants who have suffered revenue losses of more than 70% from their most recent calendar quarter. And so it did sound like they were going to be reaching out to you. I would still keep your eye on this in terms of when they're going to open the supplemental grant program. It was supposed to happen maybe a week or so ago. I'm not aware that that's happened just yet, but anytime I think you're going to be seeing more information about this. And so who would qualify for these supplemental grants? Again, they're going to give some priority to larger revenue loss organizations. And then I'll also say it is really for organizations that didn't receive the full $10 million initial allocation. So if your grant that you applied for, you received $6 million, you've got another $4 million that you could be eligible for, or I should say $3 million, because you'll see on this third bullet, it's limited to 50% of your original award and capped at a $10 million combined initial SVOG application and then supplemental grant. And so just if you're in that category, and even if you're not, even if you didn't have the 70% revenue loss, it is important to keep an eye out on what's going on with this supplemental grant program. The other thing that I think is key on the supplemental grants is it's going to extend the amount of time that you can incur eligible expenses. It's going to extend your time through June 2022. So again, I think the same expenses are eligible, but your time period is expanded, and that's going to help you capture some additional dollars. So, this is really good news. And, so you'll want to keep an eye on that. So, okay. So just wanted to make you aware of just some of the considerations or things happening with this new infrastructure bill. There's not a whole lot to talk about on this, but I do just want to mention a few things that I think are kind of important from the nonprofit community. The U.S. Senate actually passed a version of this bill on August 10th. There's a lot of good provisions in this program, like broadband access, clean drinking water, environmental remediation, just good things for the public in general. There's a few nonprofit specific provisions in there. There's a small pilot program for energy efficient grants to upgrade buildings owned by nonprofits, weatherization assistance program, low income, energy assistance program. So there's a few elements that directly impact nonprofits, but there's really not a tremendous amount in here that I can tell. So there is more work to do on this. The House of Representatives is going to be looking at it. And so what we have today is certainly not a final version of this legislation, but it seems to be moving along and has some bipartisan support. There's just some things still to work out. So just keep an eye on it. On the next slide, of course, with every bill, you have to figure out how to pay for it, right? And I think this is where more of the considerations might come from from the nonprofit sector. So these are all just ideas that have been thrown out there. So these are not final. These are just considerations that they're looking at in terms of how to pay for this bill. Expediting the employee retention tax credit expiration date, possibly ending that at the end of September instead of December. That's a big deal, and it could impact some of you all. Again, just an idea. Repurposing some of the other unused COVID dollars, like the EIDL allocations. I don't think they were fully utilized from the amount that was budgeted there. So some of those funds could be repurposed. An important one as well is clawing back or repurposing some of the ARPA state and local recovery funds. These are funds that primarily went to, we'll call it like city governments. Those funds specifically mentioned nonprofit organizations being one of the ways for those funds to be used to help meet community needs. And so some of those funds have not all been spent. There's some talk about clawing some of those back. That's that doesn't feel like a good idea to me, but that is one of the things that's under consideration. Increasing the corporate tax rate to 28%, which is right now it's at 21%. So that could have an indirect impact on nonprofits. But if you're paying tax on unrelated business income, it could have a direct impact because it'll change the tax rates for UBTI for nonprofits as well. Some talk about whether 28% is the right number. Maybe it's 25. That 25 has been thrown around as well. And then there could be other just tax changes that could have an indirect impact on charitable giving. One of the things, and Fran had mentioned this to me, a couple of days ago, and I think she's exactly right on this front. There's some talk about increasing the tax on long-term capital gains for individuals and increasing that to ordinary tax rates. So what might that do? I think you all as nonprofit organizations could have some impact on the giving and the way you get it. You might receive more gifts of stock, appreciated stock from your donors, if the long-term capital gains rate is increased on that front. So pretty interesting stuff to be considering. So that's a little bit about the infrastructure bill. Now we're going to turn it back over to Fran, and this is our first keyword for the CPE that you'll want to jot down. And so the first keyword is watchdog. If you need CPE, just jot that down on a sheet of paper and or on the evaluation form and make sure that gets back to us. So I'll turn it to Fran.
Thank you, Ken. And we'll keep an eye out on the new budget bill. That's probably going to be the one that's really going to, trying to balance the infrastructure bill. And if you are signed up for Craft's emails, we'll have updates that go out. If you're not, please contact Debbie and get on our list, and we will send out information. Sometimes it's not just about nonprofits, it'll be about the whole all tax updates, but definitely we do try to show nonprofits in the mix too. So in these times, the organizations should really be knowledgeable about what is online concerning their organization. So watchdog is our keyword, and that goes right into our next section, which is looking at charity watchdog organizations. So there are a few out there. Probably the biggest 5 are Charity Navigator, Candid, which is formerly known as GuideStar. You all know it as GuideStar. You can still go to guidestar.org and get to it. The BBB Wise Giving Alliance, Great Nonprofits, and Charity Watch. And I have to confess, I didn't really know a lot about Great Nonprofits or Charity Watch before. I pretty much focused on the top 3. So the watchdogs are basically monitoring people for compliance, monitoring charitable organizations for compliance. And they all have some kind of a rating system. So we are going to be talking about Charity Navigator today and the Charity Navigator rating system. So Charity Navigator was founded in 2001. And the goal was just to educate donors, to make decisions. They don't really like the term watchdog. We have called them watchdogs because they do have a list of not so great nonprofits, and then they have this rating system. So what's old about Charity Navigator? In 2002, they launched their star rating system. So these were organizations that were over $1 million in gross revenues, and you could have up to 4-star rating system. So it's the largest nonprofits. And it's been revised a little bit, and we'll talk a little bit more about that in a minute. Now, what's new about Charity Navigator is the Encompass rating system. So this was launched in July of 2020, and it has 4 beacons, and they've been rolling them out slowly. and they're finally rolled out. And we'll talk a little bit more. But the Charity Navigator rating is give with confidence is what they want you to show. And you'll be able to, once you have a give with confidence rating, you can show that that rating, that you have that rating on your website and in your marketing materials and donor materials. Okay, so how does Charity Navigator and how do GuideStar get the information? It comes directly from the Form 990, which is what I do. So if you are one of our clients, you know that we are very particular about sending you drafts, making sure that the wording on your program service accomplishments is exactly like you want it to be, and that it's your return. Well, when Charity Navigator gets the 990 electronically from the IRS, it is just dumped into their information. So I attended a CPE session recently with Charity Navigator, and they said that a lot of times organizations will actually contact them to say, okay, this is a typo and this is a typo and we want to change this. This is not our mission anymore. And they go, well, this was on your 990, so we can't change this. So even the typos are in there. So just be careful on that 990. Also, the 990 now, the IRS has been e-filing 990s for quite a few years, and you must have your Form 990 to be e-filed to be evaluated on Charity Navigator. So if you e-file a 990 EZ, it's not the same. You will not be rated, and also a Form 990N will not be rated. And it will say on there, you're not rated, and the reason is you have not filed a 990 electronically. You either have a 990 EZ or a 990N. So you definitely should make sure that you are on Charity Navigator. You're looking at your organization's information. You set up a portal. You can set up a portal on the Charity Navigator CN website to submit information. And we'll talk more detail about each of the beacons that is on Charity Navigator ratings. Also, you can go to Charity Navigator has a YouTube channel. So you can go and look at YouTube videos from Charity Navigator. I've looked at a few of them just for this seminar. They're really pretty good. They explain exactly why they've come up with these ratings and how they evaluate the nonprofits. So let's dig a little bit more into each of the ratings. The star rating. The star rating, it rates approximately 9,000 organizations. It is still based on finance and accountability off of 990 for the star rating. If you click on any one organization that has a star rating, it says exactly how it came up with the number and then the stars with it. What's new about this is the website changed a little bit in this last rollout that they had, the version release, is that they've also included some of the beacons that the Encompass rating has. Now, the Encompass rating has 4 beacons. One is finance and accountability, so they don't need to redo that. So they're looking at impact results, leadership and adaptability, and culture and community. And so those 3 are now being added to the star score, not to actually add to your stars and not to add to that score that the stars is based on, but as an additional amount. And you'll see it in just a second. I've got a picture of what the beacons look like scored. Okay, the Encompass rating system is the other rating system. Now the Charity Navigator is going to pull in about 175,000 organizations. So the problem with Charity Navigator felt like with their star rating system is that a lot of people didn't understand that there's a lot of nonprofits with less than $1 million in budgets that were not rated. They thought, oh, we don't have a star rating, they're no good, which we know is not true. So they felt like they needed to have something that was different, some kind of a rating system that was different that could rate those organizations less than $1 million budgets. So we've got the 4 beacons. Let's talk about those. Here are our 4 beacons: finance and accountability, which is what the star rating is anyway. Then you have impact and results, leadership and adaptability, and culture and community. So finance and accountability, we're going to dig in further on each one of those. And I'm just going to leave that as a summary page right there, and then move on to each individual. So for the Encompass rating, if you you have this kind of a look on your web page, and I'm sure a lot of you are trying to pull up yours right now. Look at it. I would be. You have this kind of look to the Encompass rating. If it was a star, then instead of the 85, it would have stars across the top too. Okay. So the Give with Confidence is for both star rating, that's a good stars, and a passing score. So the passing is 75. If you get a 74, they're saying you're failing. Seems a little bit like taking the CPA exam. You either are in or out. There's no averaging out. Okay. So you have your 4 beacons here, and you can see on this, and I've got my mouse, I'm not sure if that's coming through or not, but you've got 3 that are not scored. So most of the organizations I looked up did not have a score on the other 3. They just had the finance and accountability score. So don't freak out if you're not scored. That's why we're going through this, so you can understand how to get scored. Okay, so let's talk a little bit more about these, about what Charity Navigator does and how they do these ratings. The ratings are updated in the spring, summer, and fall. They don't like to update in the winter because that's when you have your big campaigns for fundraising and donors, and if you've got like an annual giving campaign, a lot of times that's in the winter. So the last update was in August, and so version 4 was rolled out, and at that time the leadership beacon was rolled out. The next update will be October 2021. So at the least, if you go on to Charity Navigator, you need to know when they're updating it, because your score could change. Why? Because they reevaluate weights on each of the beacons and also weights of what rolls into each beacon. So for example, finance and accountability, they may have 5 or 6 things weighted, and they may change the weights on that. So that may change your score. You want to make sure that if you are showing a score on your website from Charity Navigator, it is the updated version. And so you definitely want to make sure that you have communication, and sign up for Charity Navigator emails, when it's getting updated. At least your marketing department should, or your development crew. So how do they determine? Well, they look at their mission, what they're trying to tell donors. They look at research and analysis that's in-house. And I think they have only about 20 employees, actually, Charity Navigator. It's a really small group that does this. They get feedback from nonprofit leaders, thought leaders, and then they also have feedback from donor and site users. So if you feel like something is not right, definitely give them some feedback. It might go into the next release. Okay, so for the version 4 release in August of 2021, this was what they had. They've got impacts and results is 50%, finance and accountability is 35%, and then the other 2 are 15% total. If you do not have anything but the finance and accountability score, then that's obviously going to be 100%. So if you don't feel like you've got a really great score on finance and accountability and you can't do anything about it right now, look into the other beacons and see if you can get them scored, so that you can make that less of your total score, that one section. The only thing is, if you do culture and community only, that's the only thing that's scored, it will not result in an overall score. You'll still show that you don't have a score. And each new release will have this change, this weightage changed probably. So you want to make sure that you understand each release. So let's look at each of the beacons. Finance and accountability is your first beacon. And now this does not relate to the STAR. The STAR finance and accountability may be a little different. This is just the Encompass finance and accountability. So they look at your program expense ratio for a 3-year average, and you've got the information there. I'm not going to go into detail on that. And then the liabilities to asset ratio is on your most recent 990. So you have to have at least 3 Form 990s e-filed to be able to get this finance and accountability metric in there. So if you have, maybe you were on the cusp and you filed a 990 EZ 2 years ago, then you're not going to have the finance and accountability metric. Okay, so make sure you're getting e-filed. We'll talk a little bit more at the very end about e-filing your tax returns. Also, I think in October, they're going to publish something in their next version about the PPP, because obviously if you put your PPP as a liability on your tax return, because you can't record it as revenue until it is actually forgiven, then that liabilities to assets ratio may be skewed. And so they said that this is going to be part of their stimulus response. Now, I don't know quite how that's going to change, but I bet it's going to be changed in October. They're going to have something special about that to show, so that people don't get dinged for having a PPP loan on that. Okay, the accountability. Basically here, you're looking at 3 different factors. Audited financial statements, reviews, or compilations. This is where I disagree with Charity Navigator. For Tennessee purposes, you're not required to have an audit unless you have over 500,000 gross receipts. And if some of those are excluded, are some government grants. And so you can actually have over 500,000. That Charity Navigator wants you to have a review, a compilation, or an audited financial statement if your revenue is more than 250,000. So if you're less than 250,000, that is just it's an NA. But if you're over that, they want you to have one of those. I don't agree. I don't think it's needed, but so you probably want to look at it if this score is something that's very important to you as an organization and you're over 250. Independent board of directors, I've been preaching about that to a lot of clients. If you have less than the 50% independent board, then you're going to have a problem. So you want to make sure you've got independent board of directors. It also wants you to have at certain levels, they want you to either have 3 or 5 independent board members. So there is a minimum there also. And then the other things are items that we call, board or governance issues. And these relate to both 501c3s and C6s and C4s and a lot of the other organizations. If you want to be transparent, then you need to have your 990 on your website. You need to have a conflict of interest policy. You need to make sure you're documenting your board minutes. You have a records retention and destruction policy, a whistleblower policy. So make sure that you have those. And if you're a client and you need some help with that, we've helped clients before with, just actual documents that we can get that are just standard documents that you can tweak. Per version 3, the finance and accountability, financial is only 40% and transparency accountability is 60%. So of that total weightage, you can see that, yeah, the finance portion is important, but again, it's just like the Form 990, when your revenue and expenses are way back on page 9 and 10, they want to know what you're doing and how you're doing it more so. Okay, the second beacon that we want to talk about is impact and results. The impact and results is basically based on a lot of public information, and it's only for those organizations that are charitable revenue-based organizations. For example, if you are a museum and you charge an admission and that is your program, yes, you are a nonprofit, but the impact and results beacon cannot be scored in that case. So if you are an organization that provides a service and it's 100% charitable based revenue, then you can ask and request for an impact and results beacon. So basically you would go online to your charity navigator, and if it's not scored, you can request to be put on a wait list for this impact and results beacon if you feel like that is going to be a score that would help you out. And remember back to that previous slide, in this version, it is 50% of your total. If you have a score for that, it would actually outweigh your finance and accountability score. Leadership and adaptability beacon, you have 3 keys, and this is the new beacon. You have 3 keys on this: strategy, leadership, and adaptability. And basically they're wanting to know, what is your leadership like? Do you have a strategy? Are you trying to develop your leadership? Are your leaders going to, trying to expand their reach? How are you adapting to changes? And I've pulled in just a little bit in each one of, some more information on that. And I've got the slides up there. I don't think I'm really needing to go through that exactly like that. So I'm just going to fly through those right there. It tells you exactly what the points are and how you can get them. It's a lot of storytelling. There is supposedly a survey, and I think you have to go on and actually make sure you have a portal on your Charity Navigator site. So make sure you can log in and communicate with them, and they will give you a survey, and you can complete the survey on what you're doing in these roles. And that last bit there, 30 points, is storytelling. So get that marketing hat on and create your story. Make sure you've got a good story. You've probably already got it for your website. Make sure that they understand what it is. And make sure you can get that beacon scored or rated. Okay, so that was the last one that was just rolled out. That's the new one. Culture and community beacon is the bacon. See, I'm hungry, I guess. Beacon is the last one, and that's not going to, again, not going to result in an overall. If that's the only one you have score, it'll show, but you won't have an overall rating. So you can, on your Encompass website, you can click on culture and community, and to see why it's not scored, you'll see this information. Basically, you have to go into GuideStar or Candid and provide more information there. So I've looked, I can't quite figure out how we listen is on GuideStar. I think you actually have to log into your profile. And since I'm not a nonprofit, I can't log into my profile and find that out. But if you've got any questions about any of the beacons, we'll be glad to help you out, walk you through with those at all. The next CPE word is silo. So we have talked about silos a lot in our previous CPEs here sessions. And my next slide is about silos. So this is your second word. I think you had watchdog to begin with and silo now. And two, if you have any questions as we go along, make sure you put them in the chat and shoot them while I'm talking. Ken's looking at them. So we're trying to bounce things off. So we haven't really had too many questions so far, but if you feel like you've got a specific one, just shoot them to us. Okay, so enough about Charity Navigator. These are just some random things that we've got left over that I want to make sure are top on your list to remind you about. The UBI silos. Okay, so this started in for tax years beginning after December 31st, 2017. It was with the TCJA, the Tax Cuts and Jobs Act, and that was the biggest change in tax law that we'd had since like 1986, and then it just keeps on going. It was just the beginning of the snowball that has kept on going with COVID. Okay, so basically if you have unrelated trade or business, you need to look at what they are, and they need to be identified by using the first 2 digits of the NAICS codes, and there's 20 of them. There's 20 specific codes, and you need to silo your UBI or separate or segregate your UBI into each one of those. Okay, so if you have just rental income and that's all, and it's debt finance rental income, and so it is UBI, then that's it. That's all. And so you would just have that. But if you have rental income, but then you have some advertising from some sponsorships, then you've got 2 different UBI silos. You need to make sure that you keep them separate, and you allocate expenses based on each silo income, and that's it. You segregate everything. If you have a loss in one, it cannot offset gain in another or income in another. Okay, so you cannot aggregate the 2 silos. If you have a loss in one, then it just carries forward. Now we're going to talk about losses in just a minute, but it will just carry forward into another year and offset just that silo future income in another year. So a little bit caveats. A lot of you guys have investment income. That is usually treated as one activity, but of course the IRS says except if you have an S Corp, then it's treated as a separate unrelated trade or business. So you would have to separate that. There are so many complex rules for partnership interests. So if you have K1s that you're getting and it's all partnership interest, it really needs, there's several factors. You need to look at whether it's directly held or if it meets a de minimis participation test or a de minimis test. Then it could be that it's siloed altogether and combined, or it could be that it's its own separate silo. So the rules are way too complex and we don't have enough time today to go over those. So just know that if you have a lot of K1s that you're getting in, make sure you're looking at those to see the participation test, the de minimis test, if it's maybe the percentage that you own, that kind of thing. Okay, NOLs. This is where I was saying if you've got an NOL. So usually the NOL that's being created by your silo has to offset future income. This was all previous. This was all before COVID. It was offsetting future income, and it was subject to an 80%. So you couldn't say this NOL offsets 100% of future income. It was only 80% of the future income. So you were never going to have zero income on a year you had income with a prior year application. And then you have just your silos. This was 2018 and forward. Just your silos can only be used against silos. If you had an NOL pre-2018, that's when we could just aggregate all UBI, and it would have maybe an NOL at that point. That's what we call golden NOL. Okay. That can be used against anything. It can be used against each silo. It can be used, in anything. It's golden. It's very valuable. So the CARES Act, how did all of this change with the CARES Act? Basically, if you had an NOL from your silo years, which is 18, 19, 20, because it's before January 1, you can carry that back to the 5 years preceding the taxable year of the loss, and that does include pre-silo years. So say in 2017, you were aggregating your UBI and you had income. In 2019, you had an NOL in one of your silos. You can carry that silo back to 2017. It's very complex. And on this slide in my notes, I went clear as mud, right? So it's hard to understand. And also you have to look in your crystal ball and say, what am I going to make in the future? What kind of income am I going to make in the future? Do I have any losses in the past? Income in the past? And what is my tax rate in the past, considering, compared to tax rate in the future, which we think is going to go up. So again, you really have to balance everything. If you've got any of that, just let us know. We'll walk you through that and see if that will apply to you at all. Okay, the last thing is your e-file requirements. So the IRS finally got everything together. We've been e-filing now for a little while. So in 2020, your Form 990, all 2020 Form 990s are required to be e-filed. Well, except, this is the IRS, you have to have an except for those that maybe have an attachment that the IRS makes you file it in paper. Okay, or a short period return. Sometimes they make you file that in paper, or if you have a change in bylaw, sometimes they make you file that in paper. I'm hoping that will soon, you'll be able to attach stuff soon and send everything in. But for your most of 990 filers now are required to e-file their tax return. And what does that mean? If you are preparing your 990, this is just a full 990, the core form 12 pages plus your schedules. You will need to e-file it. How do you e-file it? If you're preparing it yourself and you're used to scribbling it down and sending it in, you will have to go on the IRS website and look at the e-file providers. We e-file all of our returns. We use one of the providers on the IRS site with our software. So there is an exception for those organizations that just have to file a 990 EZ. This is your last year. Enjoy it. You can paper file a 990 EZ. Now, I'm going to say, in my case, I don't want to send the IRS anything in paper because I know that there's still probably a truck out there somewhere at the IRS site that just still has a lot of paper from last year in it that they haven't gone through because they keep on sending notices. Oh, we haven't received this return and we haven't received this return. It were required to be filed on paper. And so because of their requirements. So I would prefer definitely to e-file anything. The 990T, yay, finally, for the first time this year, can be e-filed. Hoorah, hoorah. So that is exciting, exciting. It also has been changed and renovated, redesigned. You have a 2-page summary on the 990T, and then you have each of your silos are your supporting Schedule A. And so if you have 3 silo income streams, UBI, then you would have 3 Schedule A's, and then the 990T, the 2-page would be a summary of those 3. Just the only ones that come forward to the 2-page are the ones that have income. So the losses again carry forward, just like what I was saying before. I think that's about it. Ken, are there any questions outstanding?
Yeah, we don't have any questions at at this point, but we're still keeping an eye on the chat. So feel free to jot a question in there or reach out to us directly when the seminar is complete. So and now we're going to switch gears a little bit. You'll see Sean Owens has reemerged, and he is going to go over a topic that, boy, I'm glad you're teaching this instead of me, Sean. Leases. This is going to be rocket science, folks. And I'll turn it over to Sean, and then it'll come back to me, and we'll talk a little bit about in-kind contributions, the new standard coming there. So, Sean, off to you.
All right. Thank you very much. Does everything look good on the screen?
It does.
All right. Thank you. So we'll get started with leases. Well, if you're like me, from the mid to late 2000s, you started hearing rumblings about, well, they're going to change leases. They're going to change leases. And it heard about it for 4 or 5 years. And then, as this slide says, so originally in 2014, they issued this new guidance on leases. And like many complicated or difficult calculations, they start doing delays. And so this one got delayed a year or two here, a year or two there, and then it got delayed again with COVID. So just a quick summary. So this new lease standard, ASC 842, originally issued in 2014, with several follow-ups and clarifications issued on this topic. 1 year delay again in 2019, additional 1 year delay in 2020 due to COVID. SEC companies already had to implement this. I believe it was either in 19 or 20, but for non-public companies, it was delayed. So now effective for non-public entities for fiscal years beginning after December 15th, 2021, with early adoption permitted. So in layman's terms, because I always love when they write these standards and they say for fiscal years beginning after a date. So if you are a 12/31 year calendar year client, you would be starting this. It would start effective January 1st, 2022, but your first reporting year would be December 31st, 2022. If you're a June 30th year-end client, so the first reporting year would be June 30th, 2023, but you would start the calculation as of an effective date of July 1, 2022. Kind of went down. All right. So do I have to adopt this new standard? So if you are presenting under GAAP basis, and most people are, the answer is yes. If you've got a way not to do GAAP financial statements, and you maybe are doing cash basis currently, then you do not have to adopt this. So there's a couple of little things that you can do to make this less difficult. One of them, as the standard is written, it does not have an exemption for low value leases. However, like on fixed assets, we would recommend that you just set a capitalization threshold, much like I said on fixed assets, and document it thoroughly in your policy notes and follow it. So, if you've got a really large nonprofit, maybe $1,000 or $2,000, the postage lease, for example, that would be a good one. Those are usually very small, so you don't have to calculate it for those. The standard does have in there where short-term leases that are 12 months or less and don't contain an option to purchase the item at the end, that the leasee is reasonably likely to exercise or exclude from the standard. So you do not have to do those as well. But for the most part, every other lease is going to have to be put on there. All right. So change in terminology. So current GAAP as we sit today, it seems like it's been forever. So operating and capital leases. Operating leases, we've always just disclosed in the footnote. Capital leases, we've capitalized, put on the balance sheet, and amortized off. So under the new standard, operating and what was formerly capital leases, which will now be called finance leases, are both going on, I call it your balance sheet, but your statement of financial position. So, and then there will be additional disclosures. So this is going to be a big change to a lot of organizations' balance sheets, because there's going to be a lot of leases that were historically not capital leases. There were operating leases. Now they're going to be going on to the balance sheet. So where do you start with this process? So allocating resources to it is going to be the key. And the sooner the better that you get started. Like I said, it's really not effective until if you're 12/31 until 2022. But there's different ways, and I'll get into those later on in my presentation about what your options are for presenting it. You can either do a 1-year presentation or a 2-year on it. But the sooner you start on it, the better. So pulling that information together, getting all your leases, get them all summarized. We would recommend finding one person that will work on those items. The next thing would be, is this a lease? And I'll get into that a little bit later on, but what makes a lease, what doesn't make a lease? And then the next one would be, is this an operating or a finance lease? What is my discount rate? As you'll see, when we do the calculations for present value, you'll be using this discount rate. And then any other considerations that you need to use while doing this calculation, such as, options to extend, options to get out of leases. So again, allocate resources, identify who at your organization is going to be responsible. We really believe would be key, and make sure they have the time to get these leases together, get them summarized, and that person be the point person as you enter into new leases. That way they can calculate it, they can see what it really costs on the lease, and they can begin tracking it. So other next step would be decide how you're going to do these calculations. You can do them in Excel like everybody's been doing for years with operating leases and compiling it, or there are several other options out there for web-based software of how you can go out there, log in, do the calculation, and it will give you the information you need. So first criteria, is this a lease? Under topic 842 defines a lease as a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So the 3 main items to look for is the contract must include an identified asset. So it can't just say, we'll provide you with just X square footage of rental space. It's got to be specific. We'll provide you with office space at 555 Great Circle Road, or can't be, we'll provide you with the car. We'll provide you with a 2021 Tesla VIN number, blah, blah, blah. The other thing to look at is the contract conveys the right to control the identified asset. If the agreement has where you don't have the right to that asset, that they can take it back at some point in time, then it is not considered a lease. So the last thing for you to look at would be watch out for servicing contracts you currently have, because based off the new standard, sometimes there is actually a lease embedded in those servicing contracts. So make sure as you start this process, you're also looking at your other servicing contracts to make sure there's nothing else that has snuck in there. So what makes a finance lease? Everybody kind of knows what an operating lease is. That really hasn't changed. A finance lease, like I mentioned earlier, it's a change in terminology. It used to be a capital lease, then it became a finance lease. The big difference from the previous for ASC 840 would be that criteria. There was very set criteria of what made it a capital lease. Under this, and this is going to drive the accountants and all of us crazy, is there's a lot of, you have to look at it and you have to do an interpretation of it. So it's not as finite as previously. There's going to be some leeway here and there, but just to go over the terms. So the lease transfers ownership of the underlying asset to the lessee by the end of the term. So this is the criteria for a finance lease. The lease grants the lessee an option to purchase the underlying asset that the lessee is reasonably certain to exercise, or the lease term is for the major part of the remaining economic life of the underlying asset, or the present value of the sum of the lease payments and any residual value guaranteed by the lessee equals or exceeds substantially all of the fair value of the underlying assets. The underlying assets of such a the other thing would be if the underlying assets is of such specialized nature that is expected to have no alternative use to the lessor, then at that point in time, you would consider it also a finance lease. Other things to consider as you're implementing this, because you're going to be, like I mentioned earlier, you're going to be calculating the right of use asset, right of use liability. You'll be calculating that based off the present value of the future lease payments. So in order to calculate that, you're going to have a discount rate. So one, you'll use the rate implicit in the lease agreement unless it's unable to be determined. Some of them are always nice. It's kind of like when you get a financing lease on a car. Some of them have the interest rate in there and other ones don't. You have to back into it. So if it's not there, then you will use either your collateralized borrowing rate or your risk-free discount rate. Now, I want you to keep in mind, though, the collateralized borrowing rate is probably a slightly higher rate than your risk-free discount rate. But whatever discount rate you use, it's going to sound kind of weird, but the lower the interest rate, the larger the asset or the liability that you're going to record is. So moving on, other considerations as you do this calculation. So are there options to extend the lease, cancel the lease, and what is the likelihood of those options will be exercised? Certain lease contracts include obligations to pay for other services, such as operations, maintenance, maybe tax on the building. So for these, you will either allocate the payment between these lease components and the non-lease components. That's the standard, or there's a practical expedient available to consider all of these payments as a lease payment to be included in the asset or liability. So that would be the easiest way, would be to do the practical expedient. But keep in mind, if you do that and combine them all into this right of use asset and liability, it's going to gross up and make your asset higher, but also your related liability. So when to assess the lease. So this is another change from where we were beforehand to where we're going. So current GAAP requires measurement and classification to be assessed at inception with recognition at commencement of the lease. So under the new standard, it will be requires measurement, classification, and recognition at the commencement of the lease. So what is the commencement date for a lease? So a commencement date is the date on which a number of important determinations and measurements happen, such as lease term, lease classification, and lease payments are made related to the lease. The lease commences on the date that you take possession of the property that you are leasing. So subsequent accounting related to this. So finance leases, like I mentioned earlier, initially measured at the present value of future lease payments and amortized on a straight line basis. Liability is accreted for any interest expense and decreased by the lease payments. Operating, measured again at present value of future lease payments. Lease expense consists of periodic amortization of the right of use asset and interest expense, and liability decreased by the payments. So again, assets and liability are initially the same under both methods. All right, I'm going to stop sharing this screen right fast, and I'm going to share a different one. All right, Ken, can you see the this table, lease table?
Yes.
Okay. All right. So just to do a quick example of this. So this is an example. So this would be a 3-year lease where you're doing a payment of $7,000, $8,000, and $9,000 over a 3-year period. As you can see, under all the scenarios, your right of use asset and your right of use liability are the same to start with. So under a finance lease, which is in the middle there in gold, and under an operating lease, you start with the original same numbers. So it just, from there on, they will not tie out the exact same. So as you can see, so we get to this 20,045, that is the present value using an 8% interest rate. So you'll see under operating, again, you're doing straight line rents, has been the case. So 8,000 a year, 8,000 a year, 8,000 a year. That's your expense piece. Your right of use asset is coming down though, as you're doing that calculation. So in this example here, you'll take the 20,485, multiply it by the 8% interest rate, subtract out this payment, and you'll get to the 14,123. So you'll come over here on the finance lease. Again, you start at the same amount, and again, you'll multiply this 20,485 by the 8% interest rate, and you'll come up with an interest piece and an amortization. So this amortization piece, this is just straight up straight line amortization of the original 20,485, and then you'll add to it the interest piece. And then again, you'll come over here on the liability side, you'll see the original amount that was calculated, and then you'll take that by the 8% interest rate and you'll back out the actual payments. Because in this example, you started with the $7,000 first year payment, then you back out the 8 and you'll back out the 9. So just a quick summary of it, but this is how you would calculate one in simple terms under both different scenarios, and just calling attention of, you'll see how this gets expanded. You know, a finance lease goes up under interest expense and amortization, where an operating, it goes into the lease expense or rent. So let me quit sharing that one. Go back to my slide. All right, so just a quick summary of this. So changes in financial statement presentation. For right of use assets and lease liabilities recognized, you should either present the following. So the assets and liabilities for operating leases and finance leases are presented with current and non-current portions as either separate line items in the statement of financial position or disclosed separately in the notes to the financial statement. So you can do it either or. If disclosed only in the notes, you must make reference to where those items are on the balance sheet statement of financial position. So I've seen it both ways in the example. Some people put them straight up on the statement of financial positions, and other people lump them into other categories and then put them in the notes. So that'll be another just management's discretion on that. Let's see here. So again, statement of financial position impact. So right of use assets and lease liabilities will be presented separately for operating and finance leases on the statement of financial position, or notes for all leases over 12 months. Again, if it's under 12 months, it's carved out. And again, I think it's very important for you to set a capitalization threshold as you go through this process. So statement of activities impact. Operating leases are going to continue to be recorded as rent or lease expense. Finance leases will be recorded as amortization expense, recorded as an asset amortizes, and as interest expense, recording the payments as they flow out. So, you know, and I'll get into a little bit more on debt covenants in a minute, but as you can tell, the finance, if you have debt covenants, if you have an EBITDA calculation, the finance lease will actually is an add back, where operations is not. So changes in footnote disclosures. And I've got a few examples of this I'll show in a minute, but expanded disclosures related to the description of the lease, terms and conditions, including purchase options and termination penalties, judgments and assumptions made as you are capitalizing it, amortization of the right of use asset, what goes into the amortization expense for the year, interest costs and periodic lease expenses associated with the lease. The discount rate, you'll have the weighted average piece, you'll have the future maturities, the weighted average piece, and additional disclosures. I'm gonna share another screen right fast. Let's see. All right, so hopefully unless I've screwed up something. So anyway, I went out and Googled Amazon. So this is an Amazon footnote in the back. So this would be a policy note, but kind of what we were talking about, some of the different things you have to determine. So we'll just start here on this paragraph. So we categorize leases with contractual terms longer than 12 months as either operating or financing. Finance leases are generally those leases that are allowed to be substantially utilized or pay for the entire asset over the estimated life. Assets acquired under these leases are recorded as property, plant, and equipment. And that, again, that's an opportunity. They could break them out separately, but they put these finance leases in property, plant, and equipment. And honestly, that's where we all pretty much had most finance leases anyway, previous to this new standard there. All other leases are categorized as operating expenses, operating leases. So our lease terms generally have terms that range from 1 to 10 years for equipment and 1 to 20 years for property. So they go here in the second paragraph, they start talking about these other variables. Certain lease contracts include obligations to pay for other services such as operation and maintenance. For leases of property, we're putting all those in as a component of the lease. For the rest, they're carving those out. So as I mentioned earlier, you have the option to do either or. Amazon does one for one way and different for another. So they walk through how they calculate the lease liability. Fourth paragraph, they talk about when we have the option to extend the terms, here's what we do, or terminate them before the contract expires. And they look through it, they look to see what's reasonable on their end, and then that's how they record those. So this is a pretty good example of what you could do on a policy note. All right, last switch here. Okay, so like I mentioned, it will impact some of your debt covenants that you could have. So when you adopt this, it's going to gross up your assets and it's going to gross up your liabilities. So increase in assets, which could result in a lower return on asset. If you've got any kind of calculation on that, increased liabilities, it's going to increase the current and the non-current portion as it relates to the operating piece. Impact on working capital current ratio. And then also it's going to impact, for financing leases, you're going to reduce earnings on the front end, but large EBITDA add back. And this is where, as you're doing this process, we think it would be wise as you start doing the lease analysis. That's where it's going to be very beneficial if you do have debt for you to be working with and talking with your banker. So if you've got debt coming up that's going to mature in 2022, 2023, you may want to start looking at this calculation, doing it out there in advance. And that way you can talk to your banker and be like, we may need to change some of these debt covenants we've got, because under the new standards, we're going to have some issues with those. Let's see here. All right. So implementation methods I referred to earlier. So the modified retrospective transition with two options for initial implementation. So one option is you'll do the effective date method. So like I was saying earlier, if you're a 1231 filing entity, this is going to be applicable for you for 2022. So the effective date method, you would start accounting for this as of January 1st, 2022. So the organization's comparative financial information is unchanged. You're just going to have on your balance sheet, your income statement, cash flow. You're just going to have here's current year, here's prior year, but you're not adjusting the prior year numbers for the new standard. So that is one option. The other option is the comparative method. So you begin at the earliest comparative period presented. All periods presented will fall under the new standard. So you would go back and do a recalculation for that entire period. So I envision a lot of clients wanting to just do the effective date method. That way they've not got to go and do the calculation as of the comparative period. I believe that will be the easiest one for clients to do. But if you want the information to be fully comparative, then that's another option. Okay, so year of adoption. So applying new guidance under either of the methods discussed previously. So the other key is, in the year of adoption, you do not have to go back and say, okay, well, I had operating leases and I had finance leases under these criteria. As I mentioned earlier, capital leases used to be calculated one way. Now they're going to be calculated a different way. You don't have to go and redetermine if these leases are a capital / finance lease. You go with what it was previously, and you'll start recording it from there. So no reassessment of existing leases necessary. You'll set them up initially for existing leases as of the date of the adoption for the remaining terms of those leases. So you'll just look at what the remaining payments are and you'll go from there. So again, year of adoption. So you'll set up a right of use asset that's never been on there before for the operating. You would have already had it there for the previous capital lease. Let's see. And a big key to point out on this is the application of the standards will not result in any adjustments to your equity for treatment of these leases. So it's just going forward. You're not going to go back and adjust any equity. So I was just going to go over a few examples of where these items would go. on a financial statement. So again, I pulled up Amazon. So when you look through here, you got the accounts receivable, net other. That's where Amazon would be putting the current portion of their right of use asset for operating. And you would, for the non-current portion, they've got it down here, operating leases. And for the finance leases, as they said in their footnote, it's going to be in this PP&E line item. So on the liability side, again, they've got it buried up in some of this accrued expense and other for the current portion. And then the long-term lease liabilities, they've got that down here broken out separate. So here's a footnote in the back that I pulled again from Amazon. So this is kind of a reconciliation of how the lease expense is calculated under the different methods. So you've got operating lease. Here's that component that's going into the P&L. And then you've got the finance piece, which is made up of amortization of leased assets and interest on the liabilities. You'll have these variable lease costs, as I talked about earlier. And this gets you back to what your total expense is under the leases. And lastly, here's an example of what a footnote would look like under ASC 842. So you're, again, as I talked about, you're going to have some weighted average remaining lease terms of operating leases, weighted average remaining lease terms of finance leases, the weighted average discount rate of operating leases, weighted average discount rate of financing leases. And then here's your footnote down at the bottom that reconciles back to your statement of activities, aka the balance sheet for your right of use asset and liabilities. So lastly, I've got is we've got the next keyword that will be coming up. So the next keyword, number 3, is lease. So that would be what you'll need to put in order to get credit for CPE.
All right, thank you, Sean. And if you could
All right.
unshare your screen.
Yeah, I was trying to figure out that part. Hold on a second. I think I unshared it. So
yeah, I love technology these days.
Yep.
So
all right, I'll turn it back over to Ken.
okay, so the last topic we're going to cover today is a new standard on in-kind contributions. You know, as I was listening to Sean talk about the lease standard, I recall one of the early slides where he shared that this was initially proposed in 2014, and now we've got an initial application date starting in 2022. Well, if it talks a little bit about the complexity, here's a new standard that's for our nonprofit organizations that was actually issued in 2020, and it will be implemented before the lease standard. So not as much controversy around the new standard on in-kind contributions, but I do think it's important to share this with you. This is not terribly complex. It is very important. And I think there's really some good elements in the in-kind contribution standard that will enhance, a nonprofit financial statements, a reader's understanding about, how organizations use in-kind contributions. I think in some cases, or in many cases, in-kinds are really a notable part of how an organization accomplishes its mission. And, and so having robust disclosures about in-kind contributions, I think can be really valuable. So quickly on the effective date and transition period, it's effective for periods beginning after June 15th, 2021, with early application permitted. What that means is for you June 30, 2021, or June 30, year-end clients or organizations, the in-kind contributions you're receiving today, now in your next fiscal year, are actually subject to this standard, these disclosure requirements, things like that. So non-cash contributions you receive now, you need to be ensuring that we've accumulated the data to be able to make the appropriate disclosures on this. So what are in-kind contributions, real briefly? The in-kind contributions that are subject to this standard are contributed non-financial assets. So what is a non-financial asset? Or maybe I should say, what is a financial asset? Well, a financial asset is cash. A financial asset is also a gift of stock or investment securities. So investment securities, many of you receive gifts of investment securities, and they're actually scoped out of this new standard and disclosure requirement. That doesn't mean you don't track them and you don't value them properly and all of that, but they're not subject to the same disclosure requirements as non-financial assets. So now moving back to that, what are they? Well, fixed assets, real estate. So, I mean, these could be things that are operating items, or they could be long-term items. Somebody contributes a building to you, or the use of office space. So again, more long-term assets, they're part of this standard as well. Technical and professional services are part of non-financial assets and part of this new standard. And then in-kind advertising, we'll talk a little bit about that as well. So here's the basic rule here. Contributed non-financial assets should be presented as a separate line item in the statement of activities, separately from other contributions. Some of you may be doing that already. Some of you may not be. Under the existing GAAP, breaking it out on a separate line item in your statement of activities isn't currently required. It will be with this new standard. So you might be ahead of the game. You also have, and this is where this is going to be a change for some of you, that you have to break down in a footnote disclosure each category of your non-financial assets that are contributed. So included in that is qualitative information about whether contributed assets were monetized or utilized during the reporting period. So what does it mean if you monetize versus utilize a non-financial asset? Just a couple of examples. A monetized financial asset, let's say somebody contributes a vehicle to you and you turn right around and you sell it. You turn that into cash. And, so you'll receive auction items or another, kind of non-financial asset that can be contributed and then monetized for the nonprofit organization. You're reselling that. Utilized on the flip side is you're actually utilizing that non-financial asset in your in accomplishment of your mission. It could be physician services or clothing or something like that you're actually redistributing as part of your mission, food, things like that. So you've got to disclose your policy for monetizing and utilizing financial assets. And, and then you've got to include a footnote disclosure that includes a description of any donor-imposed restrictions. We still have considerations for donor-imposed restrictions on non-financial assets today. But just more descriptive if there's donor-imposed restrictions. And then you also have to describe, and this is actually, somewhat new or enhanced, I'll call it, a description of the valuation techniques and inputs that are used to determine the fair value of the non-financial assets that are contributed. And as you describe the valuation techniques, you need to describe in the footnote the principal market or the most advantageous market that you're using to arrive at that fair value. We'll talk about that on the on the next slide here. Okay, so and this is really this new standard did not change the valuation considerations for the amounts that you record as non-financial asset contributions. So that's important for you to know. This element of it has not changed. It's the disclosure elements that have. And so using the valuation inputs from the highest and best use of those non-financial assets is what's critical here. You do have to consider the condition or the market that would be reachable with those non-financial assets that are contributed. And let me give you an example of that. If you've received contributions of pharmaceutical, supplies, and they are still good, they're still valuable, but they're out of date. They couldn't be sold at a pharmacy or something like that. You do have to consider that condition when you're coming up with the value of those pharmaceutical supplies. So they still could have value, but they do have some, I'll call it some impairment of that value because of the condition or the market you could reach. The ultimate disposition, and again, this hasn't changed, the ultimate disposition that you'll have of that non-financial asset is not really the determining factor here as well. So again, using the example of pharmaceutical supplies, you're actually receiving those. And if your plan is to distribute those in underprivileged neighborhoods, something like that, the way that you're disposing of those non-financial assets is not going to really have a value, consideration on what you record as your in-kind contribution and your corresponding expense when you actually do make that distribution. So again, not a change. There are several tools that can be used for helping you value those non-cash financial assets. So the valuation database of Salvation Army has a donation valuation guide. When you have food or commodities, there's a USDA listing or guidance for things like that. There's a Feeding America survey for donated food. Pharmaceuticals have a pricing input catalog. And so there's a number of different valuation tips or tools that you can use to help you come up with those values. You do have to disclose, how you're actually coming up with those values. I want to make a specific mention of advertising and media contributions. So many times you might have a fundraising event or something like that where you've got donated advertising or marketing space. And if the organization is involved in trying to line up that advertising or media space, you've received a contribution. There might be other, if the organization doesn't have involvement, sometimes you might have a media outlet just promote something, but you didn't ask them to do it. You really haven't received a contribution in that sense. You have to be involved in that media placement and lining that up. The other thing that you have to really kind of watch out for with media and advertising placements is sometimes you'll see valuations provided to you that are based on like a highest rate card kind of thing. So if you've got marketing placements in the newspaper or on a billboard or something like that, they might be giving you a value based on the very highest amount that they could charge for that space. Again, I mentioned in that bullet point that you have to consider the condition or market and all of that. If you wouldn't normally have to pay that amount of money, what are their nonprofit rates if you're actually paying for placement? That's more of what you need to be thinking about and considering with the valuation of the advertising. So when we talk about donated services, and again, this is not a change, this is a reminder, they have to donate or they have to create or enhance a non-financial asset. They also have to require specialized skills are provided by entities or organizations that possess those skills, and they would be purchased if they weren't donated. So this can be a little bit subjective when you talk about whether you purchase, those donated services. So it's whether or not you need to purchase the services, not whether or not you can afford to purchase the services. So, so the affordability is not something you have to demonstrate to be able to say that you've received a contribution. It is the need for the services. So, I want to give you one other example on valuation of services that I think is important. And it's funny, the standard actually mentions, a CPA firm or accounting time. Let's say that you have a board member on your nonprofit organization that works with a big firm, and their billing rate is $400 an hour, something like that. So they serve as treasurer for the organization, but that board member or that accounting person is actually doing some of the nuts and bolts accounting work that go into creating your sets of books and records. So it's really bookkeeping services or accounting services that are being provided. You really need to value not based on the overall top billing rate, but what is the value of those services that you could get from from others, and that might be more like a $75 to $100 an hour kind of rate. And so you would value the services that you'd have to purchase were they not provided in this donated scenario, you need to factor in the actual value of those services. So using the $75 or $100 an hour or whatever that is would be the appropriate way to do that. And so just wanted to give you that clarification as well. So we'll talk a little bit about the presentation and disclosure requirements, and this is pretty straightforward. The statement of activities, this is not a big change, not rocket science here, but I think is, again, pretty helpful, and you might be doing some of this already. Before adoption, you have contributions of $30,250. After the adoption of this standard, you need to break out your contributions and break out separately your contributions of non-financial assets on the statement of activities, on the face of the statements. So this is a revenue disclosure. Want to make sure you point that out. And then you have a footnote disclosure requirement. And again, as you think about expenses, the standard doesn't speak so specifically to how you present your expenses. You do have this footnote requirement. You have a statement of functional expenses. I do think there's a lot of value if you have a notable amount of non-financial assets that are contributed to maybe describe them in your statement of functional expenses as non-cash. I think that does help a user. It might help demonstrate really what the cash needs of the organization are. So from an expense standpoint, you can have some flexibility on that. What's required from a disclosure standpoint is that you actually break out your non-financial assets that are contributed by their category, what they are. So this is a change. Where we see here, we've got a building that was contributed in this case. Well, that's something that you'll find in property and equipment, right? And then you have other operating items, household goods, clothing, vehicles, services. I'd mentioned the vehicles, for example, as something that you might actually monetize from a non-cash contribution standpoint, where the clothing or household goods, you might be using that in your mission. So let's look at the footnote disclosure narrative that would go along with this. You need to disclosure, what the policy is, what is the nature of your non-financial assets that were contributed. So that's this top paragraph here. And then if there's any donor imposed restrictions, we note here as we dissect this paragraph a little bit, unless they're otherwise noted, contributed non-financial assets don't have donor imposed restrictions. If they do, you need to describe them. And then whether they're used or monetized, I'll start at the top of this paragraph. Contributed building is located in Nashville, Tennessee. It'll be used for programming. So we're saying this asset's going to be used for general administrative activities as well. Give you another example. We talked about the vehicles down here in the fourth paragraph. All vehicles were sold and valued according to the actual cash proceeds on their disposition. So in this case, we're disclosing the monetization of the non-cash assets. Then you have to disclose the valuation methodology. So let me jump back up to the second paragraph. This is where we had the building contributed. The organization estimated the fair value based on recent comparable sales prices in the Nashville real estate market. Give you another example of valuation, and that's here in the next paragraph. It's based on estimates of wholesale values that would be received for selling similar products. In the vehicles case, it's the actual cash proceeds. And then finally, contributed services, they're reported at the estimated fair value on the date the financials, on the current rates for similar legal services. So you can see all of the different disclosure elements are described in this narrative format. I will say that there's a presentation option where you could do this in a more tabular format if you chose to do this. That if you can fit everything in and make that work, that is another acceptable way you could do this, where you could just basically have different columns. Here's the nature of the non-financial asset, whether there's donor restrictions, the valuation methodology, whether it's used or monetized. You can create a chart, so to speak, and have it in a table format in your financial statements as well. So, hope that gives you a sense of what's required in this new in-kind contribution standard. So Yeah, glad to answer any questions. I think we might have a question or two in the chat. Fran or Sean, have you been able to look at those?
Sorry, I was answering one of the questions in the chat that was related to mine. Melissa's got a question. Is there a dollar minimum? What about items donated for auctions?
Yeah, great question. And so I would say materiality does have an impact here. To the extent you've got, immaterial amounts for, for certain donated financial assets, you wouldn't have to include all of that in your disclosure. For a lot of organizations, auctions can be a pretty notable part of their, of their non-cash financial assets. So I think you'd have to consider materiality. To the extent they're material, they would need to be disclosed in that case. So.
And that's the only one I see in the chat.
All right.
Sean, there is one in the Q&A. Ken, there was one other thing that, since we have just a few minutes, on the 990 for the vehicles, if you received a donation of, a large item, non-cash item like that, and then you turned around and sold it and you didn't use it in your operations, you would need to complete an 8282 for that sale. And there are some more complex rules. And then also for your 990, don't forget that you won't be reporting any of your donated or in-kind services on your 990 or the donated use of facilities. So just thought I'd stick that in there.
Yeah, those are great clarifications. And, I know donated vehicles, that can be pretty important. But, and one of the other things I'll stress as well is that be careful as organizations giving your donor. There might be some requirements where you have to, provide an appraisal for contributed non-financial assets, something like that. But, in many cases in your acknowledgement, it might be best to say, thank you for your contribution of XYZ, and not actually state the value of that in there. It is a donor's responsibility for their own tax preparation services to establish the value of what they're contributing to you. So just something else to keep in mind. Okay, so just as we wrap up, I want to thank everybody for joining us this morning and spending some time and learning about some of these new changes.